Budget preparation is a systematic process through which organizations convert strategic objectives into detailed financial and operational plans for a future accounting period. Effective budgets facilitate planning, coordination, resource allocation, performance measurement, and managerial control by establishing quantitative targets for revenues, costs, assets, liabilities, and cash flows. Since organizational activities are highly interdependent, budget preparation requires careful coordination among departments to ensure consistency and realism. Modern budgeting also incorporates forecasting techniques, scenario analysis, macroeconomic considerations, and sustainability objectives to improve decision-making in an increasingly uncertain business environment. Principal budget factor. The preparation of budgets begins with identifying the principal budget factor, PBF, also known as the limiting factor. The principal budget factor is the resource or constraint that restricts the organization's ability to achieve its desired level of activity. Since all other budgets depend upon this limiting factor, it must be identified before detailed budgeting commences. Common principal budget factors include market demand, production capacity, labor availability, machine capacity, raw material shortages, finance availability, government regulations, or storage limitations. In most organizations, sales demand represents the principal budget factor because production and purchasing activities depend upon expected customer demand. However, during supply shortages or capacity constraints, production resources rather than market demand may become the limiting factor. Correct identification of the principal budget factor ensures that budgets remain realistic and internally consistent. Sales budget. The sales budget is normally the first functional budget prepared because it drives all subsequent operational budgets. It estimates expected sales volume and sales revenue for each product or market segment during the budget period. The basic calculation is: sales forecasts may be based on historical trends, market research, economic forecasts, customer orders, seasonal variations, and marketing plans. Since virtually every operational activity depends upon expected sales, the accuracy of the sales budget significantly influences the effectiveness of the entire budgeting process. Functional budgets. Following preparation of the sales budget, organizations develop a series of functional budgets that coordinate departmental activities. The production budget determines the number of units that must be manufactured. This ensures that sufficient goods are available to satisfy forecast demand while maintaining desired inventory levels. The raw material usage budget estimates the quantity of materials required for planned production. The raw material purchases budget then determines purchasing requirements. The labor budget estimates direct labor requirements by multiplying planned production by standard labor hours and wage rates. Similarly, variable overhead budgets estimate costs that vary with activity levels, while fixed overhead budgets estimate costs that remain relatively constant regardless of production volume. Together, these functional budgets coordinate production resources and operational activities across the organization. Cash budget. The cash budget forecasts expected cash receipts and payments during the budget period, ensuring that sufficient liquidity exists to meet financial obligations. It is one of the most important management tools because profitable organizations may still experience cash shortages. The cash budget typically includes opening cash balance cash receipts from customers' cash payments for materials, labor, overheads, and capital expenditure loan repayments and taxation closing cash balance. The basic relationship is: cash budgeting enables management to anticipate financing requirements, invest surplus funds, and avoid liquidity crises through proactive cash management. Master budget. The individual functional budgets are consolidated into the master budget, representing the organization's comprehensive financial plan for the budget period. The master budget generally comprises two principal financial statements. The budgeted statement of profit or loss summarizes forecast revenues, cost of sales, operating expenses, finance costs, and expected profit for the period, providing management with an estimate of future profitability. The budgeted statement of financial position forecasts the organization's expected assets, liabilities, and equity at the end of the budget period. It incorporates projected inventories, receivables, cash balances, fixed assets, borrowings, payables, and retained earnings. Together, these statements provide an integrated view of expected financial performance and position. What-if analysis and scenario planning. Modern budgeting increasingly incorporates what-if analysis and scenario planning to evaluate uncertainty and improve strategic flexibility. What-if analysis examines the financial consequences of changing individual assumptions, such as sales volume, selling price, material cost, wage rates, or exchange rates. Spreadsheet models allow managers to assess how sensitive profits and cash flows are to changes in key variables. Scenario planning extends this approach by evaluating multiple combinations of assumptions simultaneously. Typical scenarios include optimistic, expected, and pessimistic business conditions. Scenario analysis enables organizations to prepare contingency plans, assess risks, and improve resilience under uncertain economic conditions. Impact of the general economic environment. External economic conditions significantly influence budget preparation. Inflation increases material, labor, and overhead costs, while interest rate changes affect borrowing costs and investment decisions. Exchange rate fluctuations alter import costs and export competitiveness, whereas unemployment levels influence labor availability and wage expectations. Economic growth stimulates demand and revenue opportunities, while recession may reduce sales and increase financial risk. Consequently, management accountants must incorporate macroeconomic forecasts into budgeting assumptions to improve forecast reliability and organizational preparedness. Sustainability in budget preparation. Modern budgeting increasingly recognizes the importance of sustainability in achieving long-term organizational success. Sustainable budgeting incorporates environmental, social, and governance (ESG) considerations alongside traditional financial objectives. Budgets may include investments in energy-efficient technologies, waste reduction programs, carbon emission reduction initiatives, employee welfare, ethical sourcing, and sustainable supply chain management. Although such initiatives may increase short-term expenditure, they often generate long-term cost savings, regulatory compliance, enhanced corporate reputation, and competitive advantage. Therefore, effective budget preparation extends beyond financial forecasting to encompass strategic resource allocation, risk management, economic forecasting, and sustainable business development. By integrating operational planning with environmental and social responsibility, modern budgeting supports both organizational profitability and long-term value creation.